What I hope to accomplish today is complete our discussion of forecasting. We will do that for sure, and do the first part of Chapter 11, which is hopefully review for most of you in some form. You've taken a course in finance, and we'll talk about the capital asset pricing model, which is important to leading us into valuation, and we'll do the valuation starting on Monday. So I'm hoping to get through the capital asset pricing model. Okay, we left off on Wednesday talking about how to project expenses. Project revenues. Today we're going to start by projecting expenses. And to a great degree, projections of expenses are driven by your projection of revenues. You remember back to algebra? Anybody remember that? Algebra 2, statistics, if you took it, or cost accounting. If you have a series of information, you can, using one of two methods, thank you. You have your independent variable down here and your dependent variable here, right? And you have pieces of information, and you draw a straight line, and that straight line allows you to predict. Kind of remember this? Well, that's how we work in cost accounting with fixed and variable expenses. You have a couple of years of fixed and variable expenses. You pick maybe the high-low method. Does that sound familiar? The high-low method. You pick your high one and your low one. You have 2 points towards a line, and once you have 2 points, you draw a line. So if you think about your independent variable here being your sales or your revenues, and your dependent variable being any of many expense categories. So this is your dependent variable is your expense. You have 2 points. You can then say, where are we going in the future? And wherever you're going in the future, maybe this point here, you can estimate what it's going to be based upon that method. That's generally what we're going to talk about. If the book doesn't talk about it in these terms, I think this is an easier way to think about it, at least for me. So you can estimate based upon 2 points. You're generally going to have a growth model. So your 2 points are going to be lower, and you can start estimating past the model as you look at future growth. Right here, this says if you sell nothing, what your expenses would be. Those are your fixed costs, right? Even if you sell no units, and then the slope per unit here is to sell 1 incremental unit until you get to what it would be for the number of units you're expecting to sell. I think this is a relatively straightforward way of doing it. Your challenge is to find reasonable points for sales. One of the challenges of this model, 2 terms, one of which you've heard, one of which you may not have heard. Interpolation and extrapolation. You probably heard the word extrapolation in your life. You may not have heard interpolation. Essentially that says if you have these 2 points, your estimation between those 2 points is interpolating an estimate. If you have 2 points in a graph and you want to estimate, so you have sales of 100 here and sales of 200 here, and you want to estimate what your expense would be for sale of 150, you would interpolate that right here. And your estimate would probably be fairly strong. Interpolations are a fairly strong estimate because it's between 2 values you know. Extrapolation, on the other hand, is that you have 100 and 200 units and you want to figure out how much your expenses will be for 400 units, you need to extrapolate that because that's outside of the range of your existing data. You need to be careful with extrapolations. You need to be careful with extrapolations. Okay, think of a reason why you might want to be careful with an extrapolation.
If your sales increase to a certain point where you incur further fixed costs?
Exactly. You have to build a new plan. Things change. You overwork your current employees, and the quality goes down, and there are costs associated with quality issues. Lots of different reasons. So once you start extrapolating, you need to think a little bit more intensely about what you're doing, and is that a fair estimate? And in fact, you will primarily be extrapolating here, because you will have a growth model. Unless you don't, unless you think your company's in the decline. And they might not want to do this. Okay, so think about that. Now we're going to talk about what the book says and the way the book describes how do you forecast. But you have that model in your mind as well. Okay, so to project expenses, you should understand the nature of your industry. Is it capital intensive? Do you have lots of fixed costs? Because then you have economies of scale. Growth is going to be, your expense growth will not keep up with your sales growth, which is a good thing. Might you be in a situation where even though you have more sales, your revenues are decreasing because of competitive pressures? Some of your businesses might be doing that. I'm sorry, so your revenues are decreasing because of competitive pressures, but your expenses are going on the same. I said that wrong. So your revenues are decreasing, you're selling the same amount, but you're getting fewer dollars per sale. So your margins are decreasing because of competitive pressure. That's what I meant to say. So you need to understand the impact, on volume. That model works best on volume, not on dollars. Because that dollars adds its second variable into the equation. In an inflationary environment, how do revenues and expenses increase? Are they increasing simultaneously or not? Oil is always, the cost of gas and oil is always the best example. Those prices go up. You can't always pass that along to your customer. Sometimes you have to absorb it. And if your products are mature, generally speaking, you're probably more capital intensive. You're probably less variable cost based, and your expenses may not increase at the same rate as your revenues. Okay, so just as we talked about, you go category by category as you estimate your expenses. Cost of goods sold will vary directly with revenues more than most other categories, but much in that model. But you can use historical percentages. If you're seeing that historically cost of goods sold are 35% of, or whatever the number is, of your revenues, then you can say that's going to continue in the future, and you can, since you've projected your revenues, can then just assume your cost of goods sold will continue to be 35%. Need to be careful for a business that's global, for a business that has multiple segments. Because in that kind of a business, some segments are growing more rapidly than others, and the cost profiles of different segments might be different. Your growth segment might have a very high expense associated with it, while your mature segments may not. Pepsi's international growth versus their U.S. Flat environment would be an example. You also need to think about whether there are new technologies that might impact ongoing cost of goods sold. Are there new ways of doing business that will allow you to reduce your costs, hopefully? So, but generally speaking, just to go back, generally speaking, you can say it's varying in that model as a percent of revenues. S&A, selling and administrative expenses. Again, it generally grows as a percent of sales. You might be at a company, though, that has a flat selling and administrative expenses, not growing with sales. You don't need more overhead just because you're selling more. You're able to keep it flat from year to year. So see how your company has been. It could remain flat from year to year, slight growth, or you can simply have it grow at the same percentage as sales. Amortization of your intangibles, you should look at the notes of your financial statement, and it should tell you how you should amortize it in the future. If you have non-recurring gains and losses, don't include them in your future estimates. Because even if you had gains year after year, that's no proof that you'll have gains in the future. So, that's not ill, that's will. Okay, so you don't know what the future has, let's say for marketable securities, or something like that. Okay, so that's how you would project your expenses. Notice we haven't talked about interest expense yet. We haven't talked about income taxes yet. You don't do those until the end. You have to get some more information before you can get to income taxes and expenses and interest. Now projecting assets. Projecting assets. Many of these also will grow with sales. You need to be careful. Sometimes you need to grow assets before you grow sales. If you need to build a new plant to support new growth, new revenues, you need to build a plant before you get value from that plant. So sometimes you will choose to grow your assets as a precursor to your revenues. Other assets will trail sales. As you grow your sales, your accounts receivables will grow because of it. So it will trail sales. So we'll work with the asset turnover rates to forecast individual assets. You have to do it, think of your balance sheet, it's category by category. Let's start with cash. I did say that at the end of the day, you may use this as a plug number, but you do want to estimate it before you do that. The way you would estimate or project cash is its relationship to days of sales held in cash. So the number 365, you give you the days, you take your sales, and divide it by your average cash balance. Beginning and end divided by 2, that's your average. And that will tell you your number of days of sales held in cash. In Pepsi's case, in our book, we average somewhere between 13 and 17 days in cash. We can go, if we wanted to, we'd say best judgment here is we'll use 15 days of sales held in cash. And then because we know our projected sales value, we can then project our cash just by unwinding this. Now, one of the challenges of this model is it can create something called a sawtooth situation. Sawtooth, like, you know, the sawtooth on a saw, the teeth of a saw. They go like that, and that's the challenge. Let's say we had cash in year T minus 1 of 20, and then we had cash in year T of T0, excuse me, of 100. We would project cash in T1, starting, ending, divided by 2. 60. We project cash in year 2, but looking forward, 100 plus 60 divided by 2 of 80. In year 3 going forward, 60 plus 80 divided by 2 of 70. You can see it's low, high, lower, higher. That would kind of give the effect of taking the averages and projecting them forward. And just to go forward, 84 would be 75. And so that it'll get eventually to a steady state, but you run the risk of this sawtooth happening. And so you have the option of smoothing the sawtooth, finding out where you're trying to get to at the end, and just assume that. So what you recommended approach here is to just take multiple years of forecasts, find the average, and work from that, rather than going up and down, whipsawing between the two. And as I said, sometimes you're going to do this because you hope that you get in balance when you're done. But at the end of the day, cash might be a plug account as long as you're not plugging an outrageous number in there. So that's cash. Marketable securities. Companies investing in the stock of other companies. You can do this one of two ways, depending upon what you think is right for your company or what you've seen historically for your company. Your company might treat marketable securities as a very liquid way to get value for its cash. And so, in that case, the sum of cash and marketable securities remains constant as a percent of sales from year to year. So just as you did for cash, you can say it's cash plus marketable securities as a constant from year to year, and you calculate them together and then separate them out appropriately. Otherwise, you calculate it separately, just as you would have done in cash. You calculate it separately, saying that it's going to grow with sales, irregardless of how cash grows with sales. So there are two different models for how you would do it for marketable securities. Accounts receivable, you do the same as cash. Talked about it. Inventories, two models. Normally you do it the same as cash. However, some of our industries, a different independent variable, if you would, besides sales, predominates. In retail, might be the number of stores or square feet in stores that you would use rather than your sales. So think about your industry and say, do we really want to drive it off of sales, or do we want to drive it off of some other commonly used indicator of growth, in this case of inventories? Other current assets, some prepaid assets, advertising, insurance, etc. Anything you've prepaid. It really has to do with your expenses. And so you project it after you've calculated your total assets. You find out what historically were the percent of assets for these categories, and you plug it in as the percent of assets going forward. PP&E. It's going to be very hard for you to kind of guess when you're going to need to build new plants going forward, right? It's a difficult model for somebody without inside information to figure out. So your best estimate would say it's going to grow directly with sales. It's going to allow your extrapolation to be reasonable. Now, PP&E is interesting because it's not just the growth of an asset. It's going to create new tiers of depreciation. It might require new liabilities in order to identify the cash, get it, etc. And then go to the notes. You know how to do this now? To figure out the useful life of your PP&E so that as you depreciate it, it depreciates in the same model as the existing PP&E. Project your investment in consolidated affiliates as a percent of total assets, as we did for before. Amortize your intangible assets. I think we said this should come from the notes, and that's the best information you have. I don't think I have better information than that. And other categories, just assume they'll go with sales. Goodwill, just grow it with sales. You won't have information for impairment or where they're going to do other purchases. So you've done all this. You now have a total asset amount, and yet you kind of have this death grip because you have some assets that require on the total asset amount, but you haven't put them in, so they kind of have a death grip with each other. But once you've calculated, you can take the first pass at putting in value for those accounts. First pass. Okay. Projecting liabilities in shareholders' equity. Well, the good news is the total is known, right? You have your total assets, and assets equals liabilities in shareholders' equity, so you now have your total that you're shooting for on the other side of the equation. But of course, we're not going to use that. We're going to just let them flow the way they should flow and then fix it if they don't match. And now you have a choice here. It has to do with the capital structure, leverage, financial leverage. There's a certain ratio of liabilities to shareholders' equity that persisted over time. You believe that ratio will continue to persist in the future, whatever their leverage is. You can look at historical values to determine whether it's been fairly constant over time and therefore it should stay constant going forward, or have you seen it moving up or moving down. So you can look at your various ratios that you know about to determine whether to keep financial leverage the way it's been. Okay, accounts payable, you'll estimate your accounts payable. We're into some current liabilities now. You'll do that the same as you did cash, same model. And you'll continue to forecast your inventory purchases, your cost of goods sold that you're estimating for the year, whatever the ending inventory you expect to have minus the beginning inventory. You should have all three of those categories right now for each of your forecast years. Okay. Percent of sales for accrued liabilities. Just having a percent of sales has been shown in the past based upon history. So you guys are getting that. You go account. I'm going through these, and you may be grabbing it or you may not be. That's okay. As you do this for yourself, you go account by account, and you have to make judgments on how you're going to approach it. And if you're making some assumptions on whatever your judgments are, make sure you explain your assumptions. Your assumptions take it a different direction than this way of estimating. That's where your skill as an analyst comes in. You project your long-term debt as a percent of total assets based on historic results. Remember, you're going to be growing your PP&E as a percent of sales, so your PP&E is going to grow. You may have to be increasing your long-term debt to pay for that PP&E. You have to separate out short-term maturities and long-term debt. And each year, you have new tranches of that. Short-term debt will either be flat or trending based upon history. If you see it trending historically, then you'll probably want to keep that trend going. If you see it's been flat over time in short-term debt, just keep it approximately flat. These other items generally grow with S&A, but that grows with sales, so you can just focus it on sales. Historic. Preferred stock, I'd say, is usually a small amount. Just maintain it going forward, probably suffice. And common stock is probably be approximately the same, unless you're changing the financial leverage. Other accumulated comprehensive income. No matter what you've done in the past, it's kind of like gains and losses. Just keep it at zero. You don't know what's going to happen in the future. Some years you'll do well, some years you do poorly. Unless you're a financial services company.
You're paying for $0.
I'm sorry, just $0. Assume that there's no, that this will have no value going forward. Because you just don't know which way it's going to go. You don't even know directionally which way it's going to go from year to year. Treasury stock. You might be able to find indications in notes, management discussions that any plans. Go ahead.
Yeah. So we're supposed to account by account, and then at the end it's not going to balance, and we just plug it into cash, so it balances.
We'll get there. Okay. But yeah, that's part of the game.
Makes sense to me.
It's part of the game. Not necessarily into cash, but hopefully it comes close to balancing. Hopefully. Yeah. So I think if you're seeing a very large imbalance situation, look at some of the numbers you have and see if there may be some mistakes. It should be close enough. You don't want to just plug into cash and have an outrageous cash amount going forward. That doesn't make sense. I'll let you all decide on what to do with treasury stock. I might just assume that there'll be no change in philosophy going forward. So this is the hardest thing you're going to do, right? This is the hardest thing you're going to do. Forecasting is the hardest thing anyone does, unless you're Kreskin.
Forecasting, yeah.
You all probably too young to know who Kreskin was, or is. Who knows who Kreskin is? Nobody. Too young. You're still,
I would like to know what it is.
no, Kreskin's a person, not an it. He's one of these forecasters. Thinks he can tell when the world's going to end kind of stuff. So this is the hardest thing you're going to do. And the most important thing, because this will drive your valuation, right? Because ultimately valuation is based upon future events. You're defining the future. You can be conservative, look at the history and say we're going to be kind of like history. Or you could be outrageous, but you think your companies have a great future ahead of them. You could, you'll have some challenges because we are in we're in a very interesting time. So as you look at historic things happening, growth might look really strong because we were in a pretty bad economy a few years ago. The economy is strengthening, therefore growth looks better. Is that recent growth going to sustain through various economic cycles? So you have some challenges as you look forward. You know, what do we want to do? And that's where you get to work as a team. What do we want to do in terms of forecasting the future?
Right now, or recently and in the near future, any company starts buying stock.
Sure.
Instead of because it's not something that's going to continue sort of
Yeah. What do you think?
I don't know. I mean, I guess if it's in the notes, put it in there, but then it's
Crazy.
maybe then just return to the previous level. Yeah. Because they might plan to, but then if something changes, they might not execute that. So what's the most conservative approach to forecasting?
I don't have the magic answer. I would suggest that since you know they're doing it to keep the prices up, it can't do that for perpetuity, right? That's not a good business model. So you might want to say that cannot persist. So I think it would be conservative to say that if you think it's been, pretty aggressive over the last couple of years, that will not persist into the future. But I'm not giving you an answer. Okay, so you've done steps 1, 2, 3, and 4. You have your revenues, you have your expenses, you have your assets, and you have your shareholders' equity and liabilities, and you now can start to estimate some additional expenses, interest expense. You know your liabilities, so now you can estimate interest on those liabilities. The rate that you use, just continue with the rate that you have in the notes. Because that rate that you are paying reflects the market rate plus some kind of a risk premium that the market demands for you. Because the risk associated with it, whatever company you have, the rate that you've been paying reflects a premium that you have to pay because there's a certain riskiness of your company. So that's the best rate going forward, unless you have more information that interest rates are going to go up. Similar to interest expense, you also have income from interest based upon marketable securities, your interest in other, your non-controlling interests in other companies like Pepsi's bottlers. And apply a conservative income for that. And we'll talk about that in a moment when we get to CAPM. Any non-recurring or unusual items, hopefully this isn't a surprise, make them 0 because you don't expect them to recur. And you've probably taken them out of your historical information before you've even come here. Taxes. In the notes, it should show what the tax rate that you expect to pay. So, once you've done these items, you now have a true net income, and hopefully it's positive, and you can then determine what to do with that money. That money goes towards retained earnings or dividends to preferred shareholders who have to get the dividends and common shareholders who might get the dividends. And so you'll get to choose how to break that up. And are you going to have a reasonable growth of common shareholder dividends over time? Most companies do increase their dividend slowly and surely. If they pay dividends, they increase them slowly and surely over time. It tells the market that they're doing well. The dividend investor. Even Citibank pays a dividend. It was a big deal when they started paying a dividend again, and it's like a penny. Nothing, but he's telling the market, we can do it. We have money for you. Okay, so the next step, balancing the balance sheet. You're all done and nothing balances. Because you did things individually. You were being thoughtful in your projections. And this is where you go back to your flexible accounts. You may want to reconsider some of projections. These flexible accounts are cash, marketable securities, some of your debt accounts, the dividends that you pay, treasury repurchases. And so you can use these to get your balance sheet in balance. It has to be in balance to be, otherwise nothing is real.
Do we have to explain which account then we
Is it material? Like if you
we
let's
have
say
to
you
tell
put
you.
it in cash, and now you have current ratios that are wonderful, but you have all this cash that you just made up. I think that deserves an explanation. So, to answer your question, if it's relevant, if it's material and it's important to an analysis that you're doing, explain it. Just a stretch. Okay, one of the challenges are these co-determined variables. Co-determined variables. You have variables that are that you're going to change, and when you change one thing, it affects something else. When you change one, if you add cash, you've changed your total assets, and then you have the accounts that require total assets to match. And then your total liabilities are going to change as well, And so just think about the implications of your changes. And this could be an intractable problem, meaning it's a death grip you'll never get out of. But the good news is that Excel supports this feature, calculation iterations. So you have circular references, and it can resolve circular references for you. And this is, FSAT may be annoying, but FSAT will work. It'll help you. I sometimes get a lot of emails right around this time. So, see if that works out. Hopefully I don't. Okay, projecting the statement of cash flows. As you'll see with valuation, one of the ways that we'll do evaluation is through cash flows. And we should, because cash flows are very important. That's the real value being created, not fake value, not accrual value. The real value is cash. You can't, now you do the statement of cash flows off of all the other work that you've done. That's why it's last. You just take the information you have, and I believe FSAT will help you with this, and project operating cash flows, investing cash flows, financing cash flows. Those projections should match the change in cash from the beginning to the end of a given year. And so the statement of cash flows requires the income statement and balance sheet to balance first. That's why we do everything else. We iterate through steps 1 through 6 as long as we need to. When we're done, then we focus on cash. Does this sound like fun? You'll have fun with it. It doesn't sound like fun right now. It's more fun than it sounds, I think. Okay? Do problem 1014. 1014 with your team. It's going to focus you in a little bit on the sawtooth approach. It's a little bit, this is where an older book doesn't work. It uses Barnes & Noble as an example, and they have a compound annual growth rate of 11.6%. I don't think that's happening anymore. Use this as your guide.
Company franchise calendar size used to be a subsidiary.
Ceiling. Pause it. Did you pause it or?
No, you.
Oh, good.
Okay.
So I mean, this is pretty important.
Now we're expert forecasters.
Yeah.
We're the best. And that's the most important step. The rest of the stuff is somewhat mechanical. Gets done for you in FSAT. Well, that's not true. The first half of what we talk about in Chapter 11, what we're going to do today, is not mechanical. The actual valuations are somewhat mechanical. But if you forecasted well, if you make good assumptions on history, and then you use those good assumptions to do strong forecasts, the finance is somewhat mechanical. It's the analysis that matters. So we'll talk. How many of you have taken a finance class? Please, everybody. So this is going to be somewhat repetitive, but it might be forgotten. You might have forgotten some of this. We're now in the mode that we want to start valuing the company, and it's all based upon future flows, cash flows, dividend flows, etc. So valuing the company. To do that, we need to calculate a risk-adjusted rate of return and work with the capital asset pricing model to do that. We'll only get this far today. We'll do this starting Monday. Okay, so valuing a company. Okay, this is the statement of the obvious. When you buy a stock, only half of the equation is really well known. That's the amount you paid. Whether you've got value or not is an estimate. And that's what the stock market's doing all day. It's trying to determine value. An efficient market will do a better job of determining value. And one where information is available will do a better job of determining value. But value is not observable. The price is. And so what we are trying to do is determine value through the financial statements. That's what we're trying to accomplish here. Then you can compare that value to the stock price, and you can make a buy or sell decision. You can say the markets are inefficiently valuing the company differently than I would value that company. And that's our goal, and that's how all of you hope to get rich one day. But if I taught you a finance class, I'd say don't do it. Just bet on the market. And so value is the present value of future payoffs. That's value. And so let's look at this Greek and try to understand what it says. That says the value today at time 0 is equal to the sum of projected future payoffs for a series of periods, and these future payoffs can come in different forms, divided by 1 plus some discount rate, some required rate, to the power of the number of periods in the future that you're looking. So the first year's projected payoffs will be divided by the first power, second year by the second power, third year to the third power, etc. for perpetuity. And you do this to get true value from this coming year forever, and is forever. Now you can't do it forever. That's unrealistic. And frankly, if you remember your present values, the further out in the future you get, the less that matters. The value is less because of the time risk associated with that. So we'll have ways to avoid having to do this forever, and we've talked about doing it for 5 years. The expected projected future payoffs can come in different forms. Each have advantages and disadvantages. 3 forms that we look at are dividends, cash flows, and earnings. Dividends, cash flows, and earnings. If done correctly, they should produce identical results. Dividends, in some ways, are the best because they show you the actual value that's being delivered to shareholders, right? So up until a couple of years ago, what should Apple stock's value have been with dividends? 0. They never paid dividends. And a lot of growth stocks, tech stocks, don't pay dividends because management in those companies believe that they could invest that cash better than you can invest that cash. And I think most people would say that Apple was doing that for many, many years. So the dividend model has the strength of being the true value distributed to shareholders, but has the weakness of being at the discretion of management. Right? Management decides. So the second model is the free cash flow model. The free cash flow model says how much cash is the company providing that could be distributed to shareholders or retained for its own investment. So this free cash flow model may be better, a little harder to calculate, frankly, but may be better because it tells you the wealth that is available to be delivered to shareholders, whether or not it is. That's the free cash flow model. The earnings model. Earnings. Well, earnings are based on accrual accounting. It's based upon all this stuff that GAAP has put into place to keep everyone honest. So it has some imperfections, but it's not bad. I mean, GAAP does it for a reason. I don't want to sound negative on GAAP. It's absolutely important. But from the perspective of measuring the future, you need to be careful. So earnings measure the amount of capital that a firm can create. They can turn it into cash flows, which can then be distributed to shareholders. Probably the most removed from true value to shareholders of the 3, but on the other hand, the easiest to get to. Well, dividends are easy to get to, but it has its challenge of being at management's discretion. But the easiest to get to from an accounting perspective, and in fact, if you look at the markets are constantly talking about earnings. Earnings are used. It's real. So those are the 3 models for valuing a firm. And before we get into those models, which we'll do on Monday, we need to talk about this. We need to talk about what's that rate? What's the right rate to consider to discount these future payoffs by? So this is just a picture that shows all 3 models, if done correctly, will get you back to identifying the firm's value. It's driven from your forecasts. So let's start by talking about the risk-adjusted expected rate of return. the discount rate. And it's central to this valuation model because we need to use it to compute our present value of our future payoffs. Another way of thinking about it is it's the rate of return that investors require of a firm of your risk profile in order for them to be willing to commit capital in your firm. If you're not able to produce that rate of return, they should not want to invest in you. There's a better investment out there. And not every company has the same return because not every company has the same risk profile. So how do you figure out this discount rate? Well, you could look at the historical discount rate that's been used. If the firm's risk profile hasn't changed over time. But risk profiles change over time, right? We know that. Even for secure companies. Can you use prevailing interest rates as a starting point? But what's wrong with that? Today?
They're depressed.
They're depressed, so interest rates are relatively low right now.
No, they have jumped in the last 3 months.
Yes. Mortgage rates are up to 4%. And of course, so the firm's risk profile hasn't changed. One of the attributes of a risk profile is the capital structure, financial leverage, and if the financial leverage is expected to change going forward, then the risk profile changes along with that, either more risky or less risky, retiring debt or taking on new debt. So you need to project a future discount rate. And you would do that for each of your different types of capital: equity, debt, and preferred stock. The one we'll focus on is equity. And for that, you use the capital asset pricing model. The model assumes certain things. Investors will mitigate their risk through diversification. The markets do not reward stupid risk. And when we invest in stocks, we're taking stupid risk because we don't have information, generally speaking. And we do it for fun, we do it because we think we're smarter than the market, whatever the reason is, we invest in stock. The market doesn't reward that investment. The market rewards diversified investment. So an individual stock with its own risk profile has to have a return that makes it worthwhile for an investor to invest in that stock within a diversified portfolio. So a risk-averse investor would expect a rate of return that compensates for other uses of the money that they could use it for, rather than investing. They could use it to buy a car. And a risk premium. A risk premium. So this is the capital asset pricing model. I'm sure you've seen it in a simpler nomenclature, but let's not get overwhelmed by this. It's pretty straightforward. E just signifies expected. So the expected return you would expect on your equity is equal to the expected risk-free rate. What's the risk-free rate today? Almost 0. It's low, very low, below 1. Plus beta, this beta which we talked about at the very beginning of our class, times a risk premium, which is the expected return if you bought the entire market, the balanced risk of the entire market minus the risk-free rate. This whole thing is called the risk premium. Every company has its own beta. So let's just break this all down a little bit. So your expected return on equity, the risk-free rate is normally considered to be a short-term U.S. government security. Short-term U.S. government. It takes out two components of risk. It takes out the time component, and it takes out the failure component. The expectation that the U.S. government will not fail. So that's the rate of return that's considered the most risk-free, a short-term T-bill of some kind.
Would the 10-year treasury suffice?
That's probably too long-term.
Too long term?
10 years, a long way out.
And would
6
the stock-
months T-bill,
Okay,
3-month T-bill.
that's why you said under one. I got it now. And the second question I would have is, since their credit rating went down a notch, should we include a risk premium?
No.
Risk-free rate?
No, it's still the least risky investment out there. Maybe the Chinese government, but I would say that's got more risk too. No, you continue to think the U.S. government is the least risky investment out there. All things, all nonsense aside. And then you have your risk premium. This is the return on the overall market minus the risk-free rate. This risk premium might be higher in a weak economy, actually. It's kind of counterintuitive, because the market is a consumer who wants to use its money to pay for food, water, things like that. And I don't pay for water. I do, I guess. But pay for food and staples. The consumer needs to be incented to invest in the market rather than use the money for day-to-day investments. So there's a theory that says the market should be going up in a bad economy because of that. I put it out there for interest's sake. But I'm not an economist. And then there's beta. A beta of 1 for a given stock means that that stock co-varies with the market. Which means if the market is going up 6% on a day, like every you don't think of it every day. Every day there's different dynamics. But over time, if the market's going up a certain percentage, that stock's expected to go up the same percentage. If your beta is greater than 1, as the market goes up a certain percentage, you would expect more than that as your return because your company has a higher risk profile than the market as a whole. And if it goes up less, slower growth, it's because your company is less risky. Co-varies. Beta does not have to be positive. Can anybody think of something that might have a negative beta?
Company like maybe like a utility company? Or
No.
maybe, I was thinking of a company that has less volatility because it has a high dividend and it's more stable, and it's just people are going to react less to that.
It would still have a positive beta. It would just have a beta between 0 and 1.
Yeah, that's what
Yeah,
sorry,
I'm saying a negative
Oh,
beta.
negative.
A negative beta is possible. There's no rule that says things have to vary in the same direction, right? A negative says that when the market goes up, it's going down.
Like shorting stuff.
Well, that the stock still, that's an investment strategy to create a negative beta, yes.
Well, bonds would, but
Bonds, generally speaking, might.
Like inverse ETFs? They're not stock.
Yeah. Again, these are investment vehicles to change the beta. If you, it's like selling short. It's a way to guess that the market's going down and still make money.
But the negative beta is just going the opposite way of the market.
Yeah. An example might be gold. There's a sense that you go to gold for safety when the market's going down. And so, generally speaking, gold goes up when the markets go down. It would have a negative beta to some degree. So beta doesn't have to be positive. You'll be hard pressed to find a stock with a negative beta though. Maybe a gold stock, gold mining company. I'm not looking. Okay.
Could any commodity then be?
Well, gold's unique in that people go to gold for safety. I don't think people go to hog bellies for safety. So it's not any commodity.
Like most commodities would probably rise with the market, their price goes up.
But like,
Yeah, there are a lot of
Like
the dynamics, but yeah, I don't even want to start to guess that because I don't know the answer.
In my other college, I looked at Barrick Gold, and right now the beta is negative 0.1.
Thank you. So that's an actual gold mining company. A gold mining company has a slightly negative beta.
that could be true of then like gas. Also.
So what you're saying is, as the economy is,
Yeah, right?
say again,
Couldn't gas then also have a
gas
negative?
being oil and,
Yeah.
and why is that?
Wasn't that like inversely kind of related
I think it would be
I don't know, when the markets go up, let's say earnings are going up,
to? Yeah.
it's an opportunity to charge more for gas because you can get more. I think it would go very positively.
Okay.
A little bit outside my space, but logically, to me, it would go very positive. But, seems to me that gas companies go up no matter what's happening. Okay, so historically, the risk premiums, we talk about the risk premiums, this is not about beta now. Risk premiums tend to be, this 3.8 is a historic risk-free rate. Okay? Large stocks tend to be less risky than smaller stocks, so their risk premium tend to be smaller. As you'd expect, bonds tend to be less risky, but positive. We're talking about bonds might be negative. They tend to be positive. The average risk premium are smaller. And a T-bill would have a risk premium of 0 because that's what you're using as your risk-free rate. Yeah, yes, but this raises an important point for you all that I'm not going to give you the answer to, which is what do you use as your risk-free rate as you do your analysis of your company?
You know how you always use them? Like in any finance class.
Okay.
Isn't that what you always use? Because like in other finance class I took, you always use T-bills as your risk.
Yeah.
I've heard also that, or I've learned also it's sometimes also massive horizon of stuff. Like if you're at a company that might have a very long horizon or stable business,
You could say something else.
But if you use T-bills today, your risk-free rate is going to be what? Really low.
But that is the environment.
Yeah, but that's what it is.
Today. You're forecasting the future.
Yeah, you want to anticipate
You're
something.
not forecasting one year. You're forecasting 5 years.
For the most part, in our analysis, though, we're 3 to 5 years out, and at that point, the Fed says marginal improvement at best. Well, they're not promising. I'm going too much details.
Not too much detail. You're doing an analysis that I don't want the whole class to do together. I want you to do it within your team and argue and come up with a
I was
number.
gonna ask, can we anticipate growth in the T-bills? Change our structure?
That's going to create a tough model if you
Yeah, I know.
can have a different discount rate for each year going forward, right? Yeah, that's a model that I'm not suggesting on you. I think you can take a shortcut there.
Okay.
This is for valuing, not projecting. Or is present.
This is for evaluating. This is the denominator of the valuing. This is intrinsic to the denominator of the valuing equation.
So you bring the cash flows.
And so this is just another picture of CAPM in process. This is if your beta were 0, then you're at the risk-free rate, that's the T-bill. And it's linear with the betas. And here's a look at beta from the perspective of industries. Now, I didn't talk about this. I think I had it. I'm sorry to do this. Beta is tough. If you look at different sites, Yahoo Finance versus Bloomberg versus others, and you look at the beta for your company, you're going to get different numbers. Because there are different ways of calculating beta. They should be relatively consistent, but they are going to be slightly different. Some use different time horizons. Some, they calculate it differently. So you need to choose the beta of your choice. And if you believe that you're, in your forecast that you're changing the capital structure of your company, you're taking on more debt, you should factor that in as you calculate your beta going forward. You're adding risk to your company, and your beta should be different than the reported beta from the past if you're changing the risk profile of your company. Probably, I'm not sure many of you are going to be doing that, but I'm open to you doing it. It makes for a good discussion. So back to this slide. This slide just shows betas in 2004 for a variety of industries. Some will make utilities, very low beta. Whether you're making money or not, you're going to turn the heat on. So they're really tied up in fixed costs, not variable costs. So the beta is relatively low. And then above 1 down here, you have growth companies. You have companies of a higher risk. Okay, just this should take you about 12 seconds. I gave you 20 seconds. If Pepsi's beta is 0.75, T-bills are returning 3%, and the risk premium is 4%, what's Pepsi's cost of capital? Cost of equity capital? What's that?
I didn't say that.
Somebody here said something.
I didn't say that.
Somebody threw their voice right at you.
I'm good at making people think it's who you're talking
Yeah, right.
3.75. 3.75.
Oh. Okay, 20 seconds are up. Who has it? Throw some numbers at me. What do you think it is?
6%.
3.75.
I heard 6. I heard 3.75. Any others? Any others?
12%.
What's that?
6.
You just saying that, or?
I'm just saying that.
3.75. I concur. 3.75.
Okay, who said 3.75? You got that 6 of you? Maybe 8? Now who said 6? Who said 6?
We did, but we might be doing it wrong, so that's why.
We have 0 people saying 6. And we have 22 people saying nothing. What's the correct answer?
But you have to do the risk.
It's 6.
But what about the risk-free rate?
Trust yourselves.
How do you do it?
God damn.
It's your rate of return.
0.75 times 1%.
Expected rate of return is equal
Oh,
to
because of the
risk-free rate plus beta
The
times
T-bills
the
is
market
zero.
risk premium.
T-bills return.
Right? So your risk-free rate is 0.03, excuse me. Right, that's the T-bills. Your beta is 0.75, and your market risk premium is given to you 0.04, so it's equal to 0.03 plus 75% of 0.04, which is 0.03, which is equal to 0.06.
And that didn't
I think it's worse that you got it and you didn't believe in yourself than
I
if you
kept
didn't
trying
get
to
it
say
at all.
there's one big person agreeing, but we were talking over each other, so it didn't work out.
Confusing. I did not proceed.
Okay, you see that now?
Wrote it down.
I did 4% minus.
That's what I did. Yeah.
So the trick here is that we gave you the market risk premium. We didn't give you the
So
market
many
return.
That's a damn.
The market risk premium is the return minus the risk-free rate. So when you got the 375, you did the 4 minus 3.
Yeah.
Yeah.
And then took 75% of that. That's the little trick of the question.
They never give you the risk.
Okay, the viability of the capital asset pricing model. It's the best we got, so that's what we use. But as we said, market, the beta is sensitive to time, it's sensitive to methodology. So you're creating this discount rate that you're going to use based upon a static or a one-time beta that might be changing over the course of the life of that company. We've already talked about the risk-free rate. You don't know what to use in today's marketplace. You have to think that through. And the risk premium usually is based upon, the market return is usually based upon something like the S&P 500. And the S&P 500 is skewed greatly to large cap U.S. stocks. In fact, all U.S., but skewed towards large cap. That's not truly representing the market as a whole, right? So what do you use?
The Russell 2000?
That would be skewed towards small cap.
I think you use this because it's what everybody else is using.
You use this because it's what, yep, probably use this, but it's imperfect, right? It's not giving you the true return. And our companies are all global, so our discount rate should reflect their global nature, and it's nowhere, well, I guess these companies are also global, so it's somewhat reflected in them. It doesn't consider other alternative investments, which this is only assuming that, remember, this is what the investor needs to get as a return in order to invest in your company, but maybe real estate's a better investment. Doesn't have any thoughts about real estate. So, it's imperfect. We'll talk about this when we get to actually doing our valuations. When we do our valuations, we're going to do, I'm going to ask you to do sensitivity analyses. Don't just assume whatever you have as your discount rate is the only answer. You'll do sensitivity analysis across multiple discount rates to see whether your buy or sell criteria hold up after you've done some sensitivity analysis. It's important to do that because it's an imperfect measure. I think that's all we got. Yeah. Two more slides. It's not much. You can deal with it. 3 more slides. So that was the cost of equity. That's how you figure out the cost of equity. Now you need to figure out the cost of debt. The cost of debt is the after-tax cost. You figure out the after-tax cost of debt. It's the yield to maturity factored in for the taxes on your interest. Yield to maturity is the rate that discounts the cash flows from your debt. Let's say you have a bond that has a coupon. These are terms you may or may not remember. It's less critical to this class, frankly, than the equity, but I want to go through it anyway. So you have a bond with a coupon. That coupon may be discounted because the interest rates have changed over time. And let's say interest rates are going up and your bond is paying you 5%, but they should be paying you 8% in today's market. That bond's not worth as much as it used to be worth. It's not paying you enough. So the yield to maturity takes into consideration that the interest rates have changed and the coupons that you're getting, the periodic payments that you're getting for that bond are not adequate based upon the current risk in the market. So the notes will state what the interest rate on the debts are, and it will state the fair value of the debt. You should just use that. Since you're going to need the cost of debt, use what the notes tell you. Okay. Next, you have the cost of preferred stock, and for most companies, preferred stock is almost immaterial. But if you need to figure out the cost of preferred stock, it generally trades at par, and is the periodic dividend, that's the value. So you figure out the rate. Of that dividend. This brings us to the weighted average cost of capital. Weighted average, that just means you factor in how much of each type of capital your company has, and you weight it. So you figured out your cost of debt, you figured out your cost of preferred stock, and your cost of equities, and your weighted average cost of capital just has a weighting factor times the amount, the rate for your debt, a weighting factor times the rate for your preferred stock, and a weighting plus a weighting factor times the rate for your equity discount rate. The sum of your weighting factors equals 1. So think about the right-hand side of your balance sheet, the percentage of each of these 3 categories on the right-hand side of your balance sheet. You would use the weighted average cost of capital. You would use this when you do an analysis to value a company for the purposes of acquiring that company. We're going to be doing the valuation for the purposes of determining whether a stock price is right. We only care about this, the discount rate for equity. But if you're thinking about acquiring a company, look at all of the different vehicles.